Welcome to the Deep Dive, the show where we cut through the noise and get straight to the insights you need to navigate a complex world. You know, we all strive to make good decisions, whether it's managing our finances, planning our careers, or just the small daily choices that shape our lives.
Right.
But if you're anything like me, you've probably had those moments looking back thinking, what on earth was I thinking? We often fall prey to these incredibly predictable patterns of error, don't we?
It's absolutely true. And what's truly fascinating here, I think, is that these aren't just random, isolated mistakes. They're not just oops moments.
Yeah.
They're deeply rooted psychological tendencies, almost hardwired into our cognitive processes that consistently lead us astray. It's like our brains are running on, ancient software in a modern world.
Right, right.
And those old programs sometimes create spectacular bugs in our judgment.
And today, we're peeling back the layers of human psychology with, well, one of the greatest minds of our time. Legendary investor Charlie Munger, Warren Buffett's longtime business partner and intellectual force. We're diving into his renowned framework, The Psychology of Human Misjudgment.
Munger's profound insight, which he articulated so powerfully, is that understanding these 25 cognitive biases, these inherent flaws sort of in our thinking, is essentially a shortcut to worldly wisdom.
Mm-hmm.
It's about seeing the world clearly and perhaps even more critically, avoiding disaster. He believes that if you truly grasp what makes people predictably irrational, you gain an immense advantage in almost every aspect of life. It's a mental toolkit for navigating reality.
And our mission for this deep dive is to unpack the first 15 of these incredibly powerful biases. We're going to offer clear explanations, compelling real-world stories, often from the high-stakes worlds of finance and corporate life, and, most importantly, practical antidotes for you, our listener. We're aiming to arm you with a sharper mental toolkit to navigate complex decisions with greater clarity and hopefully a lot less regret down the line.
And this isn't just academic theory. It's really about practical application. By understanding these common pitfalls of the human mind, you can actively learn to sidestep them.
Right.
Whether you're evaluating a potential investment, managing a diverse team, or simply making a personal choice, recognizing these biases in action of yourself and others will make your future decisions far more effective. It's about building that awareness muscle.
So settle in. Get ready for a journey through the why behind some truly irrational behavior, complete with surprising facts and just enough humor to keep you hooked. Let's jump right in. Hashtag 1, reward and punishment super response tendency.
Okay, let's kick things off with what Munger considered, well, one of the most important drivers of human behavior, the reward and punishment super response tendency. This is all about what truly drives us, right? The carrots and sticks that shape our actions, often far more profoundly than we even realize. It absolutely is.
Yeah.
Munger's core idea here is that our actions are drastically influenced by incentives and disincentives. I mean, it sounds obvious, but the degree is what he emphasized.
Yeah.
He notes that even well-intentioned, otherwise ethical people can be driven to immoral or irrational behavior when these incentives are strong enough. He famously declared, never, ever think about something else when you should be thinking about the power of incentives.
Wow.
In essence, people respond to incentives, for better or worse, and will often rationalize their behavior to serve those incentives.
Yeah.
It's a primal, incredibly potent force.
And we saw a pretty infamous and frankly shocking example of this with the Wells Fargo scandal back in the 2010s. Here was this major bank imposing these incredibly aggressive sales quotas, heavily rewarding employees who met those targets, and just as heavily punishing those who fell short.
A textbook case, sadly. The outcome was a massive scandal. Thousands of bankers under immense pressure opened millions of fake accounts without customer consent. They did this purely to hit their numbers. The incentive, keeping their jobs, earning bonuses, avoiding, public humiliation internally, was so powerful that employees drifted into immoral behavior, as Munger might put it, while rationalizing it as just doing what was necessary to survive.
Harry.
What's even more insidious, I think, is that management was often blinded by the appearance of growth these incentives produced.
Right, the numbers looked good.
The numbers looked great until the whole fraudulent system inevitably collapsed. And we saw similar profit incentives lead Salomon Brothers to skirt Treasury auction rules back in the 1990s. It's a recurring theme.
It's incredible how those pressures can make seemingly normal people justify almost anything, can't they? It's not just about greed, it's about avoiding pain too, like you said.
Precisely. And this doesn't just apply to outright fraud. Incentives routinely shape corporate and investor behavior in more subtle yet equally damaging ways. Leaders might game the system to trigger personal bonuses. perhaps by pulling revenue forward to meet quarterly targets, which isn't sustainable.
Yeah.
Or sales staff might actively missell products if the commission structure encourages it, even if it's clearly not in the client's best interest.
Yeah.
The profound insight Munger gives us here isn't just that incentives matter, but that they create their own reality, often blinding management to the underlying dysfunction because, again, the numbers look good.
Until they don't.
Until they spectacularly don't. In Munger's words, misaligned incentives can lead to systemic misjudgment.
So what does this all mean for us, for the listener? How do we use this insight to make better decisions?
Well, Munger's most important rule in management is crystal clear. Get the incentives right. He urges leaders to design systems that reward true desired outcomes.
Not just fakeable metrics.
Exactly. And dread and avoid rewarding people for what can be easily faked. For you personally, it means being deeply skeptical of advice from those whose compensation is directly tied to your decision-think commission-based sales or some financial advisors. Always ask yourself, what is the reward or punishment driving this behavior? As Munger famously put it, show me the incentive and I will show you the outcome. It's a powerful, almost diagnostic lens to view the world through. #2, liking, loving tendency.
Okay, here's where it gets really interesting and perhaps a little uncomfortable. We're naturally drawn to things we find appealing, people, brands, ideas. It's just how we are. But how much does that liking influence our judgment, sometimes without us even realizing the full extent? It's more than just a simple preference, isn't it?
Oh, it's far more potent than a simple preference. Munger defines it as our natural tendency to love, admire, or sympathize with people and things we find appealing, and this liking bias dramatically skews our judgment. It's not just a gentle nudge.
Right.
When we like someone or something, Munger says, we ignore faults, comply with wishes, favor people, products, and actions associated with the object of our affection, and distort other facts to facilitate love. It creates this powerful, often self-reinforcing feedback loop. Admiration increases love, which in turn increases admiration, sometimes even leading to what he called deliberate self-destruction to help what is loved. Pretty extreme stuff.
And we've seen this play out spectacularly and sometimes tragically in the investment world with charismatic founders, haven't we? I mean, you think about WeWork and Adam Neumann or Elizabeth Holmes and Theranos.
Absolutely. Those are prime examples. With WeWork, Adam Neumann's charisma and grand, almost messianic vision were so magnetic.
Yeah, he had that energy.
That major sophisticated investors like SoftBank just seemed to overlook glaring business flaws. The lack of a clear path to profitability, the astronomical spending, the conflicts of interest, they were simply smitten. Similarly, Elizabeth Holmes of Theranos cultivated this visionary, almost heroic image, winning over famous board members and investors, even though her biotech device never reliably worked.
Right.
In both cases, the powerful admiration for these individuals led to ignoring red flags, suspending critical thinking, and frankly, skipping proper due diligence. It's like an investor falling in love with a stock. They might ignore poor earnings or competitive risks, actively rationalizing away any negative information, sometimes even inventing positive facts to confirm their affection.
So it's not just about romantic love, clearly, but any strong emotional attachment that can blind us, even in the supposedly coldest business decision.
Precisely. And this can lead to pervasive favoritism and irrational loyalty.
Yeah.
A manager might promote or favor an employee they personally like, despite, mediocre performance, because they want them to succeed.
Sure.
Boards may be too lenient with a CEO they admire, leading to a critical lack of oversight during crises. Investors overpay for glamour companies or hold on to a failing investment long past its sell-by date because they're emotionally attached to the idea of it.
Yeah.
The profound insight Munger gives us here is that affection doesn't just blind us to flaws. It actively rewrites our perception of reality, making us not just tolerate, but often defend the very things that are against our best interest simply because we like them. It's kind of self-reinforcing delusion.
So how do we avoid falling head over heels for the wrong idea or person, especially when the stakes are high? How do you guard against that?
The key antidote, according to Munger, is objectivity. Easier said than done, of course.
Of course.
But he advises developing the habit of seeing it like it is and welcoming bad news about things or people you love. Actively seek dissenting opinions. If you have a favorite stock, deliberately read bearish analyses to counteract that bias.
Force yourself.
Force yourself. For a new hire, try to blind yourself to their background or connections if possible. As Munger puts it, you may need to see the faults in love anyway, But first, you absolutely must open your eyes to those faults. You can't make good decisions based on affection alone. Hashtag tag 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 3. Disliking hating tendency.
All right, now for the flip side of liking our tendency to overly dislike people or things, and because of that, we just can't judge them fairly. This one feels a bit more visceral, almost primal, doesn't it? Hatred, or even just strong dislike, can be incredibly destructive to clear thinking.
It is, and Munger highlights its profound impact. He explains how hatred makes us do 3 things, essentially. First, we ignore virtues in the disliked person or thing.
Blind spot.
Big time. Second, we dislike people and things associated with the target, even if they're perfectly fine.
Guilt by association.
Exactly. And third, we actively distort facts to confirm our hatred.
Yeah.
We look for reasons to dislike them more. It leads to closed-minded decisions, personal feuds that escalate way out of proportion, and what we often call the not invented here syndrome in companies.
Oh, yeah.
Where a perfectly good idea is rejected simply because of who proposed it or where it came from. This hatred-driven distortion can be, in Munger's words, shockingly large.
A truly dramatic example that comes to mind is Henry Ford II firing Lee Iacocca. I mean, Iacocca was this brilliant executive, right? Responsible for iconic products like the Mustang, record profits for Ford. Yet he was let go because of this deep personal animosity with Ford II.
That's a textbook case of the disliking tendency, completely overriding rational business judgment. Henry Ford II famously told Iacocca, "Sometimes you just don't like somebody."
Wow. Just like that.
Just like that. This decision was clearly against the company's objective interest, and the consequences were pretty immediate. Iacocca went on to lead a spectacular turnaround at rival Chrysler, becoming one of the most celebrated executives of his era.
Right.
Ford Motor Company not only lost a star leader, but watched him resurrect a rival automaker. Henry Ford II's hatred overrode objective business judgment, ignoring Iacocca's clear virtues and distorting facts to confirm his dislike. You see this also in managers overlooking truly good ideas from a disliked employee.
Happens all the time.
Or an investor refusing to buy fundamentally great stock simply because they personally dislike the CEO or the industry, maybe for political reasons or something.
So the cost of a grudge, or just a strong aversion, can be astronomical then, both financially and professionally. It's not just hurt feelings.
Yeah, absolutely. Yeah. This bias leads to missed opportunities and inefficient decisions. If an investor is biased against an entire sector, perhaps due to a past bad experience or a political aversion, they might ignore fundamentally sound, undervalued investments.
Right.
In mergers and acquisitions, deals can be scuttled not on merit, but because executives on both sides personally dislike each other. It also fosters toxic corporate cultures where infighting is common. Munger emphasizes that hatred makes decision-makers closed-minded and can lead to irrational moves that ultimately harm one's own interests more than the target's.
So how can we keep our grudges or strong dislikes from costing us, both personally and professionally? How do you manage that emotion?
Well, Munger would advise us, pretty bluntly, not to make major decisions in anger or under the influence of strong dislike. Be acutely aware when a personal aversion is coloring your judgment.
It's the knife awareness again.
Always. Actively seek virtues in people or ideas you dislike. Force yourself to list their positives. It's hard, but necessary. Implement objective processes like diverse decision-making committees, so one person's grudge is less likely to dominate. And cultivate equanimity, a sense of calm detachment. As the old proverb goes, don't cut off your nose to spite your face.
Right.
Decisions driven by hatred or intense dislike almost always end up harming the hater more in the long run. Hashtag tag tag 4. Doubt avoidance tendency.
We all crave certainty, don't we? That discomfort with doubt, with ambiguity, it can be really powerful. It pushes us to make quick, sometimes potentially wrong decisions. It feels like our brain just wants an answer, any answer, just to alleviate that uncomfortable feeling of not knowing.
It's profoundly true. Our brain is programmed, Munger argues, to quickly remove doubt by reaching some decision, especially when we're puzzled or under stress. We instinctively prefer a firm answer, even a wrong one, over enduring ambiguity. Munger highlights that the brain of man is programmed with a tendency to quickly remove doubt by reaching some decision. This leads to snap judgments or premature conclusions, often solely to allay discomfort, rather than patiently seeking more information or just waiting. It's an evolutionary shortcut that can be a modern pitfall.
I think we've all seen this play out dramatically in market crashes. Investors, during something like the 2008 financial crisis or that sudden COVID-19 crash in March 2020, The uncertainty is unbearable for many.
Right.
They panic sell to escape that helpless, ambiguous feeling, just get me out.
Precisely. Selling often gives this false, immediate sense of control, a quick resolution of doubt, even though it usually locks in losses at the worst possible time.
Yeah.
Investors later admit they sold not purely out of rational analysis, but an overwhelming, almost visceral urge to do something amidst the overwhelming uncertainty. Similarly, in corporate decision-making, a doubt-averse CEO facing an ambiguous crisis might hastily scapegoat someone. Or rush out a half-baked PR statement, rather than admitting they need time to investigate thoroughly. Scams, too, brilliantly exploit this by creating artificial urgency. This offer expires tonight, to prevent potential victims from taking time to think, to doubt, and crucially, to verify.
So the discomfort itself is the primary trigger, more so than actual logic sometimes.
Yes, the psychological discomfort of uncertainty is the engine here. This tendency leads to impulsive decisions and snap judgments made with incomplete or insufficient information. It's why people panic sell or rush to buy hype stocks without proper research.
FOMO kicks in.
Exactly. In business strategy, it can cause premature consensus, where teams settle on a plan not because it's definitively the best, but because they're uncomfortable remaining undecided. Munger ties this directly to stress. Under threat or confusion, the urge for a quick decision is strongest, leading to rash, often regrettable actions.
So how do we learn to sit with that discomfort? How do we learn to tolerate ambiguity for better, more measured results? It's not easy.
It's definitely not easy, but cultivating patience and tolerating ambiguity is absolutely key. Munger and Buffett are famous for often not acting when others panic. They're comfortable saying, "I don't know yet," and waiting for clarity for the fat pitch.
Right. Their inaction is action.
In a way, yes. For you, the listener, consider using investment checklists that explicitly prevent trading during high panic moments, forcing a rational pause. For major life or business decisions, try a 24-hour rule. Sleep on it before acting.
Good tip.
Seeking calm, objective third-party advice can also provide invaluable perspective when your own doubt aversion is pushing you towards hasty action. Recognize that the discomfort of doubt is a natural impulse, but not one that always leads to the best outcome. It's a signal to pause, gather more info, not necessarily to leap. #5. Inconsistency avoidance tendency.
Right, we're creatures of habit, no doubt about it. We like consistency. But sometimes sticking to our guns, even when we're clearly wrong, can be incredibly costly. This is our inner resistance to change, our mental inertia that keeps us on a familiar, even if it's a detrimental, path.
Exactly. This is our profound inner inertia, or resistance to change. Once beliefs, habits, or routines are formed, we strive to keep consistent with them, regardless of new evidence, sometimes especially in the face of new evidence. Munger famously observed that people tend to accumulate large mental holdings of fixed conclusions and attitudes that are not often re-examined or changed, even when there is plenty of good evidence they are wrong. Changing course creates deep psychological discomfort. It means admitting a past mistake, which we naturally avoid, so we resist it.
Yeah, nobody likes admitting they were wrong.
Right. And this often leads to the sunk cost fallacy and an unwillingness to pivot, even when it's clearly rational to do so. It's encapsulated perfectly by that phrase you hear all the time. Well, we've always done it this way.
Kodak is just the quintessential example here, isn't it? I mean, they invented the digital camera.
Invented it?
But then clung tenaciously to their highly profitable film business, fearing cannibalization. It was a fatal consistency.
It was, and a tragic one for such an iconic company. Kodak essentially refused to embrace the future it helped create, remaining heavily invested in film and hesitant to commit fully to digital, even as rivals like Sony and Canon leapfrogged into the new era.
They just couldn't let go.
They couldn't let go. They missed the moment entirely and ultimately filed for bankruptcy. This is a direct mirror of how investors often hold on to a losing stock, refusing to sell because it means admitting their original decision was a mistake.
Yeah.
They remain consistent with their original decision, even as losses mount, ignoring the accumulating evidence.
Right.
The Concorde jet project is another classic example of the sunk cost effect, where more and more money was poured into a clearly doomed project simply because so much had already been invested, and stopping would mean admitting that past investment was a waste.
So this bias prevents us from adapting when we really should, often to our own detriment. It keeps us stuck.
Precisely. It leads to stubbornness and missed opportunities. Entire companies become slow to adapt. Think Blockbuster ignoring Netflix's rise, or BlackBerry clinging to physical keyboards in the smartphone era.
Yeah.
Individuals may stick with poor career paths or bad investments out of sheer consistency with past choices rather than evaluating their current situation effectively. It also underpins escalation of commitment, digging a deeper hole, and contributes significantly to groupthink, where dissenting data is ignored to maintain a united front and a consistent narrative. As Munger puts it, it's much easier to prevent a habit than to change it. The initial adoption is critical.
Okay, so how can we embrace necessary change without feeling like we're constantly flip-flopping or admitting defeat? How do you build that flexibility?
Well, Munger, quoting Ben Franklin, advises, "An ounce of prevention is worth a pound of cure." Be incredibly careful what beliefs, habits, or initial commitments you adopt in the first place, because they're incredibly hard to change once ingrained.
Be deliberate upfront.
Very deliberate. Encourage continuous re-examination through processes like postmortems or regular strategy reviews. Personally, actively ask yourself this key question. Knowing what I know now, would I still make this choice or hold this belief? This directly counters the sunk cost mindset.
That's a good one.
Munger also practices inversion, brutally checking his own best-loved ideas for errors. And crucially, create a culture, whether in a team or just for yourself, that doesn't punish changing one's mind when warranted by new evidence. Think of Intel's famous pivot from memory chips to microprocessors. They consciously overrode their past identity to embrace a new future based on the evidence. That took courage. #6, curiosity tendency.
All right, moving on. Not all biases are bad. This one, number 6, usually works strongly in our favor. Our innate desire to learn, explore, and understand. It's what gets us out of bed in the morning, right? Our natural drive to figure things out. Curiosity.
Absolutely. Humans have a powerful inbuilt desire to learn, explore, and seek novelty. Munger includes it in his list because he acknowledges its profound and generally beneficial influence on our judgment and success.
Right.
He notes that the curious are provided with much fun and wisdom long after formal education has ended. It's the engine of discovery and innovation, often acting as a crucial antidote to other biases, like inconsistency avoidance or doubt avoidance, because it prompts deeper digging rather than accepting superficial or convenient answers.
Yeah, it pushes you past the easy answer.
Exactly. Without curiosity, we become stagnant. However, Munger might add a small caveat. Without focus, it can sometimes lead to shiny object syndrome.
Ah, okay. The story of 3M and the invention of Post-it notes perfectly illustrates how curiosity, especially when nurtured within an organization, can lead to incredible breakthroughs from unexpected places.
Right. It's a fantastic, almost legendary example. 3M's famous 15% rule allowed employees, like Dr. Spencer Silver, to essentially tinker during work hours. He developed this peculiar, low-tag adhesive that didn't stick very well. Technically a failure.
A failed glue.
Right. But it was only when another scientist, Art Fry, was curious about how to use this failed adhesive to mark pages in his hymn book without damaging them that the Post-it note was born.
Amazing.
This wasn't a planned invention. It was born purely from curiosity, experimentation, and an open mind. Munger and Buffett themselves are famously voracious, multidisciplinary readers, perpetually curious about how the world works. Munger explicitly credits curiosity-driven learning as a factor that helps man prevent or reduce bad consequences arising from other tendencies.
So it counteracts the bad stuff.
It can. However, as I mentioned, it's worth noting the small risk. Too much undirected curiosity can sometimes lead to misjudgment. Think of tech firms jumping into every new VR or AI fad without a clear business plan, simply because it's novel and exciting.
Right, chasing the next big thing without a strategy. So it's about channeling it then, not suppressing it. It's a positive force that, if harnessed correctly, can give us a significant edge.
Exactly. High curiosity individuals and organizations tend to gather more knowledge, which naturally leads to better, more informed decisions and greater adaptability in a rapidly changing world. It fosters superior problem solving. It can powerfully counteract complacency and doubt avoidance, pushing us to ask more questions, better questions. The main risk, as we discussed, is over-exploration or lost focus. But overall, Munger sees it as probably much more good than bad, a fundamental virtue of the human mind.
So how can we cultivate and keep this valuable trait sharp in ourselves and our teams? How do you stay curious?
Munger's advice here is simple but profound. Remain a learning machine. He stated quite directly, you need a lot of curiosity.
Just keep learning.
Keep learning. Read widely, across disciplines. Don't just stay in your silo. Ask probing questions, not just surface-level ones. Seek new perspectives, especially those that challenge your existing beliefs. For leaders, create an environment that actively rewards intelligent inquiry and experimentation, rather than just immediate predictable results.
Make it safe to ask dumb questions.
Absolutely. Balance that curiosity with execution, perhaps by setting aside dedicated exploration time without neglecting core responsibilities, similar to Google's famous 20% time policy. The ultimate takeaway for Munger is profound. Never stop learning and questioning. It's a lifelong commitment. #7 Kantian fairness tendency.
Okay, next up, the Kantian fairness tendency. We all want things to be fair. It's a deep-seated desire, almost an instinct. But sometimes our sense of justice, our internal fairness meter, can override pure logic, leading to some surprising and sometimes economically irrational outcomes.
It's an incredibly strong, often subconscious desire for fairness and justice, rooted in what Munger calls the golden rule, do unto others.
Right.
That sort of thing. We go to great lengths to enforce perceived fairness, even if it hurts ourselves financially. Studies like the famous ultimatum game show this clearly. People consistently reject beneficial financial offers if they seem unfairly lopsided. They'd rather get nothing than let the other person get an unfair share.
Even if it costs them money.
Even if it costs them money. Our fairness sense can definitely override pure rationality and self-interest. Munger even alludes to how Capuchin monkeys exhibit this. He mentioned studies where they throw cucumbers back at researchers if another monkey received sweet grapes for the same simple task.
Cucumber rage.
Exactly. It's deeply ingrained, ancient, and often pre-rational.
We've certainly seen this play out dramatically with customer boycotts over perceived unfair pricing. You think of the public outrage over EpiPen price hikes or the whole Farmer Bro Martin Shkreli saga. The outrage was palpable and people acted on it.
Absolutely. People are willing to suffer inconvenience or go out of their way boycotting, protesting, public shaming to punish what they perceive as gouging or exploitation. During natural disasters, stores that price gouge face immense public backlash and boycotts that can linger.
Yeah, bad PR.
And it links directly to employee morale, too. If a company's wage policy is perceived as grossly unfair, workers might strike, or their morale and productivity can plummet, even if objectively their wages are still competitive in the market. Fairness isn't just a moral principle. It's a powerful psychological trigger that motivates real-world action.
So fairness can be a powerful motivator for both good and ill, sometimes leading to decisions that aren't strictly rational in a purely economic sense.
Yes. Positively, companies that adopt genuinely fair practices often build immense customer loyalty and employee morale. Think Costco, that's often cited.
Yeah.
Those are powerful competitive advantages. Negatively, it can cause inefficient outcomes, like rejecting beneficial business deals if the split isn't perceived as fair by all parties, even if everyone would be objectively better off taking the deal. It fuels labor strikes, can complicate international trade negotiations, and even contribute to trade wars. Fairness is a moral compass in decisions, Munger suggests, but it's not always aligned with cold economic logic, and it can lead to suboptimal choices purely to satisfy that deep-seated instinct.
So how can we balance our powerful sense of justice with practical wisdom and objective decision-making, especially when the stakes are high? You don't want to be a doormat, but you don't want to cut off your nose.
Exactly. Munger advises recognizing when fairness leads us to cut off your nose to spite your face. Before making a decision driven by perceived unfairness, ask yourself, am I refusing this deal or decision solely because it doesn't feel fair, even though objectively it might still benefit me?
Tough question.
It is. Communicate fairness concerns constructively, not just reactively. Critically, treating stakeholders with genuine fairness up front can prevent many of these issues from even arising. Companies like Costco, as mentioned, build immense loyalty by consistently being perceived as fair to customers and employees. If you have to make a decision that might be seen as unfair by some, explain the reasons transparently and empathetically. It's about being wise about fairness, not just reactive to the feeling of unfairness. #8, envy, jealousy tendency.
Envy. Munger called this the only deadly sin you can't have any fun at all with, yet it's an incredibly potent and corrosive force. It's that deep-seated compulsion to compare ourselves to others, and it drives so much behavior, often hidden beneath the surface because, well, nobody likes admitting they're envious.
It truly is potent, and Munger emphasized how destructive it is. Envy is the compulsion to compare ourselves to others and resent those who have more, or achieve more. He noted it pushes people into foolish decisions just to catch up or even spite others, usually fueled by a zero-sum fixation, the flawed idea that if someone else has more, it must mean I have less.
Right.
It operates subtly because admitting envy is largely taboo in society. Munger mentions that labeling a position or action as envy-driven causes deep offense, especially, he notes wryly, when the diagnosis is correct, which speaks volumes about his hidden power and our denial of it.
The investment world seems particularly susceptible to this, doesn't it? Especially during speculative bubbles. People jump into hot markets seemingly out of envy, seeing others making quick fortunes and feeling desperately left out. That FOMO again.
That's a prime example. And FOMO is often just envy in disguise. During the dot-com boom, many people, maybe even intuitively, knew valuations were irrational, but envy got the better of them, Munger would say. Seeing others profit from risky stocks, an investor jumps in without proper research, leading to losses. They just couldn't stand watching their neighbor or coworker get rich quick.
Yeah.
We saw similar dynamics in the housing bubble and with a more recent meme stock craze. Envy also drives competitive one-upmanship in business, leading to ill-advised mergers or acquisitions just to appear larger or more dominant, not necessarily for sound strategic reasons. It can even lead to internal sabotage within companies.
Wow.
Munger makes a powerful, stark point that envy is a really stupid sin because it's endless. You'll always find someone with more, doing better, seemingly luckier. Warren Buffett's famous anecdote about someone being deeply unhappy with a huge, say, $2 million bonus because a colleague got $2.1 million perfectly illustrates this insidious self-defeating nature. It poisons your own happiness.
That's so relatable, unfortunately, and also so depressing when you think about it. So how do we protect ourselves from this incredibly destructive emotion and its influence on our decisions? How do you fight envy?
Munger's advice is characteristically blunt. Avoid envy, like the plague. Easier said than done, obviously.
Obviously.
But one powerful tactic is to actively reframe other success as inspiration rather than a personal yardstick or threat. Practice gratitude. Consciously focus on what you have achieved and possess rather than what you lack compared to others.
Focus on your own lane.
Exactly. Focus on your own lane, your absolute progress toward your own clearly defined goals. Limit social comparison, especially in areas where it breeds discontent. Maybe spend less time doom scrolling on social media comparing lifestyles. Buffett and Munger famously avoid envying high-flying tech investors during bubbles, sticking steadfastly to their circle of competence and long-term value investing principles. Huge discipline. Some even suggest practicing mudita, the Buddhist concept of taking sympathetic joy or actively rejoicing in others' good fortune. It's the opposite of envy, and it's a much healthier place to be. #9. Reciprocation tendency.
Okay, number 9. Reciprocation tendency. This one is deeply human, almost a fundamental social contract, right? We feel obligated to return favors, and unfortunately, often to retaliate against harms. It's the scratch my back and I'll scratch yours principle, and it's incredibly powerful in shaping interactions.
It's absolutely hardwired into us. We're inherently wired to reciprocate favors and retaliate against harms, and it often operates subconsciously below the level of conscious, rational thought. This tendency is the basis of social cohesion, trade, friendship, and even deterrence in international relations. You give something, you expect something back. Well, it generally fosters cooperation and positive social dynamics. It can also be easily manipulated or lead to irrational, escalating paybacks if we're not mindful.
We see this all the time with gift-giving in sales, or even more nefariously, in bribery. You think of financial brokers lavishing clients with free perks or expensive dinners, subtly inducing an unconscious obligation to do business with them.
Exactly. Financial writer Matt Levine has often quipped that Wall Street sometimes operates on a gift economy. Sam Walton, the legendary founder of Walmart, was famously strict about this. He forbade his purchasing agents from accepting even small gifts from suppliers.
Really? Even small ones?
Even small ones. Because he understood how a seemingly innocuous favor could subtly bias them to reciprocate with favorable deals later on. The Walmart Mexico bribery scandal, years later, where officials were alleged to have received payments for permits, shows the extreme consequences when that kind of policy erodes, highlighting how officials might feel compelled to return favors with favorable treatment. Even in everyday office dynamics, if you cover a colleague's shift, you'll find they're much more willing to help you out later. It's automatic. In negotiations, making even a small concession often creates a powerful, unspoken pressure for the other side to reciprocate with one of their own. Skilled negotiators use this all the time.
So it's a mechanism that can be easily exploited, leading us to decisions we might not otherwise make, based purely on obligation, not merit.
It absolutely can. This tendency means you can be influenced to do things you wouldn't otherwise, due to a sense of obligation rather than pure merit. It leads to agency costs and significant conflicts of interest. Think of a financial advisor recommending a certain mutual fund because they receive perks or higher commissions from its provider, not necessarily because it's the best objective option for you. Munger warns about the misleading use of reciprocity in politics or quid pro quo arrangements, where favors are exchanged under the guise of legitimate dealings. On a retaliation side, it fuels vicious cycles, like escalating price wars, where each aggressive move is justified by reciprocating the competitor's last action, often to the detriment of everyone involved.
That eye for an eye cycle just spirals. So how can we navigate this without being manipulated, or perhaps even harder, avoid getting into a destructive tit-for-tat retaliation cycle?
Well, the key, again, is heightened awareness. Be mindful when you receive something free in a business context. Mentally label it as marketing or sales tactic to help maintain objectivity.
Reframe it.
Reframe it. Implement clear policies like Sam Walton's, limiting gift acceptance to avoid insidious bias creeping in. For personal actions, pause before retaliating. Often, consciously not escalating a conflict leads to a far better long-term outcome. Choose your battles. Reciprocate deliberately and in proportion, not automatically or excessively. Munger also highlights Berkshire Hathaway's culture of deserved trust, where managers feel a strong, positive urge to reciprocate the immense trust Buffett places in them by performing well. So you can use the bias for positive outcomes too. It's about being intentional with your reciprocation rather than letting it run on autopilot. Hashtag 10. Influence from mere association tendency.
Okay, number 10. Influence from mere association. Our brains are constantly linking things together, ideas, people, objects. It's how we make sense of the world. But sometimes those links, even if they're purely accidental or completely irrelevant, can profoundly color our entire judgment of something. It's powerful how easily we transfer qualities, isn't it? Like a mental contagion.
It is a core fundamental mechanism of how we perceive the world, and it's deceptively powerful precisely because it's often subconscious. We automatically link ideas, people, and things together, and the association alone colors our feelings and judgments. We often judge something not on its own intrinsic merits, but by what it's associated with. It's the A is linked with B, so I transfer the qualities of B onto A effect. If B is positive, A gets a halo effect. If B is negative, A gets a stigma or horns effect. Munger explicitly warns that some of the worst errors in judgment come from these accidental or misleading associations. He even cites the ancient Persian messenger syndrome, where the bearer of bad news was often killed, simply for being associated with the unwelcome message. Ouch. Don't shoot the messenger. Celebrity endorsements are the most obvious, ubiquitous example today, right? Think of athletes in sports drinks or movie stars selling luxury watches. We subconsciously transfer their positive qualities to the product.
Exactly. A beloved celebrity endorses a product, and suddenly consumers subconsciously feel it must be superior or cooler or more trustworthy, even though there's usually no logical connection between the celebrity's talent and the product's actual quality.
Sales typically increase because people transfer those positive feelings for the celebrity onto the product. On the negative side, consider guilt by association. During Volkswagen's Dieselgate scandal, other German car makers' stocks also took a temporary hit, as some investors associated German automakers with the cheating, despite no direct link for those other companies. Munger's point about the Persian messenger syndrome highlights how we mistakenly attribute characteristics of the message or event to the messenger, leading to irrational reactions like blaming the analyst who delivers bad news about a stock. The Marlboro Man, for decades, successfully created a powerful association between rugged independence and smoking.
So it's not just about the celebrity. It's about any link, positive or negative, that can hijack our objective assessment of the thing itself.
Right. It means we can be manipulated by irrelevant correlations. This bias underpins the halo effect, where if we like one aspect of a person or product, we tend to assume all aspects are good, and the horns effect, the inverse dislike one aspect, dislike all. It causes us to choose familiar vendors over potentially better new ones just because they're familiar. It makes stocks rise or fall in sympathy with peers in the same sector, regardless of individual fundamentals. And it contributes significantly to stereotypes. Munger encourages us to see it like it is and love or judge anyway, implying we must consciously separate the object or person from its associations to judge fairly and on its own merits.
So how do we see things clearly? How do we separate them from the glitter or the stigma they're associated with and judge them objectively on their own terms?
The key is conscious awareness of these associative triggers. When evaluating anything, an investment, a person, a new idea, actively ask yourself, Am I judging this solely on its own intrinsic facts and merits, or am I being unduly influenced by who or what it's linked to?
Be explicit about it.
Be explicit. If it's the latter, make a conscious effort to discount that association and seek independent, objective evidence. Munger's antidote to the Persian messenger syndrome is profound and worth repeating. Develop the habit of welcoming bad news. Actively reward those who bring problems or negative data to your attention rather than associating them with the negativity. Consciously seek disconfirming information about beloved ideas or people. As the cliche goes, and Munger would certainly agree, never judge a book by its cover or by who endorsed it. #11. Simple, pain-avoiding psychological denial.
All right, number 11. This one hits close to home for many of us. I suspect our profound tendency to simply deny reality when it's too uncomfortable, too painful to face. It feels like a self-preservation mechanism, maybe, but it can be incredibly damaging in the long run because you're just not dealing with it.
It is, and Munger regards it as one of the most dangerous biases for exactly that reason. This is the tendency to deny or distort reality when it's too painful to accept. Munger describes it bluntly. The reality is too painful to bear, so one distorts the facts until they become bearable. While it can momentarily buffer us from acute stress or grief, it often leads to far worse problems down the road because it entirely prevents timely corrective action. If you deny the problem, you can't fix it. He connects it to incredibly powerful emotions, like dealing with love, death, and chemical dependency, but he also emphasizes its manifestation in more mundane business contexts all the time.
BlackBerry's decline offers a really stark corporate example, doesn't it? When RIM's co-CEOs initially dismissed the iPhone as no sea change for their business, looking back, that feels like pure, unadulterated denial.
Absolutely. Their public statements, and likely their internal thinking, reflected a clear psychological denial of a fundamental shift in the market. They were too invested, both emotionally and financially, in BlackBerry's past success and its signature keyboard design.
Their identity.
Their identity. They couldn't face the painful fact that their core product concept was rapidly becoming obsolete. This denial of the uncomfortable truth delayed essential adaptation, allowed competitors like Apple and Google to gain an insurmountable lead, and ultimately led to a massive loss of market dominance.
Yeah.
We also saw this with Kodak's denial about digital photography, which also tragically led to its downfall. On an individual level, a portfolio manager might stubbornly deny that a particular investment is failing, blaming external factors like the market or the Fed purely to avoid the psychic pain of admitting a mistake.
Right. It was my fault.
Exactly. Munger shared a poignant story of a friend's mother who, after her son died tragically in war, continued to set a place for him at the dinner table every night, unable to accept his death. That's denial in its most raw, painful form.
So it's one of the most insidious biases because it just completely prevents any corrective action or learning from mistakes. You're stuck in a false reality.
Indeed, it is one of the most damaging biases because it prevents corrective action. If you won't admit a problem exists, you literally cannot fix it. Organizations in denial ignore early warning signs until problems explode, often when it's too late to resolve them effectively. It interacts powerfully with confirmation bias, seeking info that supports the denial, and inconsistency avoidance, sticking with the denied reality.
It's a cocktail of bad judgment.
It really is. It creates a powerful psychological fortress around incorrect beliefs. As Munger notes, hope is not a strategy, and denial often boils down to clinging to an unjustified, unrealistic hope. In business, denial can be fatal. And it's not just individual. Subordinates can even participate in the boss's denial, creating a dangerous bubble of unreality where no one dares to tell the emperor he has no clothes.
So how do we force ourselves or our teams to face uncomfortable truths head-on, even when it absolutely stings and every fiber of our being wants to look away?
The antidote, as Munger preached and practiced, is brutal honesty and an unwavering willingness to face discomforting facts. It takes courage. Munger's own approach was legendary. He'd actively try to kill his own best-loved ideas by deliberately seeking out evidence against them.
Stress testing them.
Exactly. Organizations can institutionalize this with red teams or by appointing devil's advocates whose explicit job it is to challenge assumptions and find flaws. Foster a culture, this is crucial, that welcomes bad news as a gift, as an opportunity to improve, not as a threat or a sign of failure.
Yeah.
Personally, try a pre-mortem technique. Imagine your project or investment failed catastrophically a year from now, and then work backwards to list all the reasons why it might have failed. Quantification and using external reference points or base rates can also pierce subjective denial by grounding things in objective reality. As Munger famously said, you have to see the world the way it is, not the way you want it to be. It's a lifelong discipline, not a one-time fix. Hashtag 12, excessive self-regard tendency.
Okay, number 12. Ego. Overconfidence, thinking we're better, smarter, or more capable than we actually are. This one feels like a truly universal human trait, doesn't it? And it can certainly lead to some spectacular falls from grace. We all fall for it to some degree.
It's profoundly true, and Munger hammered this one relentlessly. This is our natural, almost ingrained tendency to overrate our own abilities, achievements, and prospects. Munger dryly observed, he mostly misappraises himself on the high side.
Yeah.
This includes the endowment effect, where we irrationally overvalue things, our house, our ideas, our stocks, simply because we own them. It encompasses illusory superiority, where statistically most people believe they're above-average drivers, leaders, thinkers, you name it.
Which is impossible.
Mathematically impossible. And it includes attribution error, where our successes are due to our innate brilliance, but our failures are always due to external unlucky circumstances. This bias cocktail can lead us to take immense, unprepared risks based on inflated self-assessment.
The story of long-term capital management, LTCM, back in the 1990s, perfectly illustrates this hubris, doesn't it? Here you had a hedge fund started by PhDs and literal Nobel laureates, utterly convinced of their own infallible intellectual superiority.
Absolutely. LTCM's core belief in their perfectly calibrated, supposedly infallible mathematical models, coupled with the use of massive, potentially catastrophic leverage, stemmed directly from extreme overconfidence in their own brain power.
They thought they cracked the code.
They genuinely believed they had. Their early, dazzling success just amplified this self-regard, making them feel virtually unbeatable. They were, in their minds, the smartest guys in the room. When an unforeseen event, the Russian debt default, exposed the fundamental flaws and hidden risks in their models, their hubris led them to initially double down, convinced the market was simply wrong, not their genius models. The result was a near-total collapse, requiring a massive, multi-billion-dollar Fed-orchestrated bailout to prevent systemic risk. It's a classic example of what some call CEO disease, or the kind of hubris that leads to disastrous acquisitions like AOL Time Warner, where overconfident executives push through massive deals, absolutely convinced of their own singular prowess, ignoring all the warning signs and naysayers.
So even the smartest people, the most credentialed, the Nobel Prize winners, can be completely blinded by their own overconfidence and excessive self-regard. It's almost frightening.
One of the most humbling lessons Munger teaches, I think. Excessive self-regard leads to overestimation of one's capabilities and an underestimation of risks and challenges. Overconfident traders take excessive risks, entrepreneurs expand too fast without the capital, and CEOs dismiss expert warnings because they think they know better. It severely degrades learning, because if you think you're already the best, or close to it, why would you listen or feel the need to grow? The endowment effect means product developers can fall in love with their own creations, resisting better external solutions or feedback. Attribution errors, I'm a genius for success, unlucky circumstances for failure, prevent proper, honest analysis of mistakes so you don't learn from them. Munger even notes that criminals often justify their actions and maintain a strangely positive self-image due to this excessive self-regard.
So how do we balance that necessary confidence? You do need confidence to achieve anything significant with a healthy, grounding dose of humility. How do you keep the ego in check?
Munger offers a clear path, though it requires constant vigilance. The best antidote to folly from an excess of self-regard is to force yourself to be more objective about yourself.
Easier said than done.
Always. Surround yourself with truth-tellers. People who aren't afraid to challenge you, not just sycophants who echo your brilliance. Rigorously track your own predictions versus actual outcomes. Keep an intellectual journal to stay honest about your actual foresight, not your perceived foresight.
Keep score.
Keep score, honestly. Invert the scenario. Ask, if someone else with my exact track record and situation proposed this plan, would I objectively bet on them? Embrace continuous learning, which inherently instills humility by constantly exposing you to new knowledge and the vastness of what you don't know. As Warren Buffett advises, it's better to be approximately right than precisely wrong. Don't chase false precision born of overconfidence. Use tools like position sizing limits and investing in predefined checklists and complex tasks to curb the impact of overconfidence, even if you can't eliminate the feeling. And study base rates, what happens on average in similar situations, to ground your unique, often overly optimistic estimates in statistical reality. Hashtag 13.
Over-optimism.
Tendency.
Okay, number 13. Over-optimism tendency. Our natural inclination to see the bright side, to expect good outcomes, is usually a very good thing. It keeps us motivated, driving forward. But sometimes it pushes us towards overly rosy predictions that just completely ignore or downplay potential risks and obstacles. We just want things to work out maybe a little too much for our own good.
Indeed. This is the tendency towards excessive optimism, even when it's completely unwarranted by the facts or historical precedent. Munger famously called an excess of optimism the normal human condition.
We're wired for it.
We seem to be. We instinctively expect things to turn out better than statistics or objective analysis might justify. This leads, almost inevitably, to a systematic underestimation of risks and, crucially, insufficient preparation for the inevitable downsides and setbacks that life throws at us. While a degree of optimism is certainly motivational, Munger warns that unchecked over-optimism can lead to surprise, shock, and severe losses when reality inevitably fails to meet those sky-high, unfounded hopes. He explicitly highlights that the trained, disciplined use of basic probability math is a key antidote here.
The dot-com bubble's business plans in the late 1990s come to mind immediately again. Startup after startup projecting unbelievably rapid user growth, guaranteed market dominance, astronomical earnings, often despite having zero revenue or a flimsy business model. It was pure, unadulterated over-optimism, wasn't it?
It was a classic, widespread example. Companies like Webvan, that online grocery startup, optimistically assumed incredibly quick, profitable expansion across the country. They spent hundreds of millions building massive, automated warehouses based on these rosy forecasts.
I remember them.
Only to spectacularly go bankrupt when reality hit. Entrepreneurs routinely ignored base rates, the historically high failure rate of startups, convincing themselves and their investors that this time is different, or we're the exception.
Right.
Investors believed new internet companies could defy economic gravity and only go up, driven by a sort of utopian vision of the future. We saw a similar widespread real estate optimism leading up to the 2008 financial crisis. Housing prices never go down nationally.
Famous last words.
Exactly. This is also a major component of the planning fallacy, the well-documented tendency to underestimate the time, costs, and risks of future actions, while simultaneously overestimating the benefits. The Sydney Opera House is the classic poster child, estimated to take 4 years and cost $7 million. It famously took 14 years and cost $102 million. That's over-optimism in planning. It also contributed tragically to disasters like the Space Shuttle Challenger, where engineers' serious safety concerns about the O-rings were dismissed or downplayed due to an overly optimistic launch schedule pressure from management.
So it's really about being hopeful and motivated, which is good and necessary, but also critically pragmatic and ruthlessly realistic about the potential risks and challenges involved. That's the balance.
Exactly.
Sure.
Over-optimism inevitably leads to inadequate preparation for downsides and overcommitment to rosy scenarios. It results in overextension, taking on too much debt, assuming revenues will soar, expanding too fast into new markets before consolidating, or paying an unjustifiably high price for an acquisition based on wildly optimistic synergy forecasts. Over-optimistic CEOs often dismiss valid worries from their team and can silence dissenting voices. Personally, it causes people to save too little for retirement, thinking they'll always earn more later, or rack up credit card debt, blithely believing they'll easily pay it off soon. It pairs dangerously with incentive-caused bias, if you're rewarded for optimistic forecasts, and social proof, if everyone around you is optimistic.
So how do we stay hopeful and motivated? Because you need that without being completely blind to the very real, often uncomfortable risks. How do you inject that dose of realism?
Munger advises, quite simply, applying simple probability math. Ground your decisions in hard statistics and base rates, rather than just relying on your gut feeling or best-case scenario narrative.
Look at the data.
Look at the data. Use premortems, as we discussed before, to force consideration of negative outcomes before you commit. Take an outside view. Look at the historical success and failure rates for similar ventures or projects undertaken by others, not just your unique special vision. Consciously pad your estimates for time and cost. Tarana. Daniel Kahneman suggests adding 50% or more.
Wow.
Encourage a devil's advocate role in your team to actively poke holes in optimistic assumptions. On a personal level, do a realistic worst-case scenario analysis. What happens if things go really wrong? Track your past predictions against reality to identify and adjust for your own personal optimism bias. Munger stresses that denial and undue optimism can make you happy in the short run, but it's a terribly ineffective way to handle reality. So aim for rational optimism. Hope for the best, but diligently, rigorously prepare for the plausible worst. ###14. Deprival superreaction tendency.
Okay, number 14. This is a truly powerful one, I think, and it underlies so much human and market behavior. Our intense, often irrational reaction to losing something, or even just the threat of losing something. It's why losing $50 hurts so much more than finding $50 feels good, isn't it? The asymmetry.
It's absolutely profound, and the asymmetry is key. This is the strong, often irrational reaction people have to losing something, or even the mere threat of loss. It squarely encompasses loss aversion, the well-documented psychological phenomenon, largely credited to Kahneman and Tversky, showing that losses hurt roughly twice as much psychologically as equivalent gains feel good.
Twice as much.
Roughly, yes. It also covers the extreme behavior we sometimes see when a near miss of a gain is snatched away at the last second. That feeling of being deprived of something we almost had can be incredibly motivating, often negatively. Munger notes, man ordinarily reacts with irrational intensity to even a small loss or threatened loss of property, love, friendship, status, or any other valued thing. This explains everything from sour grapes when we narrowly miss out on something to why negotiations often deadlock over seemingly small concessions. Nobody wants to feel like they lost.
The common investor error of refusing to sell a losing stock, desperately hoping it will just climb back to even so they don't have to book the loss. That's a perfect illustration of this, right? Often called get-even-itis.
It's a classic, incredibly common, and often financially destructive behavior driven squarely by deprival superreaction. The psychological pain of confirming a loss by selling is so strong and aversive that investors ignore all objective analysis, ignore opportunity cost, what else they could do with that money, and just cling on, hoping against hope. They hold on to stocks that have dropped significantly, far beyond what any fundamental analysis would justify, simply because they cannot bear to make that loss real on their statement. During the dot-com crash, countless investors held cratering stocks all the way down to zero or near zero. Even a near miss, like almost getting a highly sought-after concert ticket only to have the website crash, can cause an intense emotional reaction of deprival. Bidding wars at auctions also clearly show this. The sense of being deprived of their prize if someone else outbids them drives bidders to irrationally overpay, falling victim to the winner's curse. Okay. Munger also references Mark Twain's wonderful anecdote of the cat that sat on a hot stove once. That cat, Twain noted, would never sit on any stove again, hot or cold. It learned, but it overreacted to the pain and the threat of future loss.
So it really clouds our judgment, making us act irrationally just to avoid that painful feeling of loss, even if those actions lead to even greater losses or missed opportunities down the road.
That's precisely it. It leads to suboptimal, emotion-driven decisions aimed at avoiding or undoing losses, often at disproportionate cost. It's a major contributor to the sunk cost fallacy, where we continue investing time or money in a clearly losing venture because acknowledging the loss of what we've already put in is too painful.
Throwing good money after bad.
Exactly. It causes impasse in negotiations when neither side wants to concede, fearing they will lose face or lose on a point. In corporate strategy, it can lead to destructive price wars or desperate, unprofitable competitive practices just to regain lost market share. Investors, as we said, consistently hold losers too long and often sell winners too early. Locking in a gain feels good, but they might miss bigger upside due to fear of the gain turning into a loss. It also causes status quo bias, our preference for things to remain the same, partly to avoid the perceived loss associated with change. And marketers heavily exploit this with urgent fear of loss messaging. Limited time offer, don't miss out.
So how do we accept losses, which are inevitable in life and investing, and make rational decisions even when it stings, when our whole being is screaming to avoid that pain?
The first crucial step is to recognize loss aversion in yourself and acknowledge that the pain is real and natural, but it doesn't have to dictate your actions. Try to normalize the pain. Understand it's a bias. For investors, setting predefined stop-loss rules or automatic rebalancing plans in advance when you're calm and rational helps remove emotion from the sell decision later on.
Automate it.
Automate it or pre-commit. Invert your perspective constantly. Ask that key question again. Knowing what I know now, and if I had the cash, would I invest in this today? If the honest answer is no, then the fact you already own it shouldn't matter. Sell it. Think clearly and explicitly in terms of opportunity cost. What else could that capital or effort be doing for you right now? Try framing things as potential gains from reinvestment instead of locking in losses. Use commitment devices or a clear objective criteria for decisions. Practicing Stoic philosophy can also help temper the superreaction by reminding yourself that nothing is truly owned forever, and excessive attachment inevitably causes suffering. And Buffett's timeless advice is directly relevant here. Don't risk what you have and need for what you don't have and don't need. Protect your downside from this bias. Hashtag 15. Social proof tendencies.
All right, number 15, the last one for today's deep dive. Social proof tendency. This is the ultimate monkey see, monkey do bias, isn't it? When everyone else is doing something, thinking something, buying something, we often just assume it must be right, or at least okay, regardless of what our own instincts or independent analysis might tell us. It's the powerful magnetic pull of the crowd.
It's the herd instinct, pure and simple. Munger describes it as an automatic tendency to think and act as one sees others around him thinking and acting. It's especially powerful, he notes, in ambiguous or uncertain situations where we lack clear individual guidance and instinctively look to others for cues on how to behave. What's everyone else doing? Okay, I'll do that too.
Safety in numbers, maybe.
Partly, yes. We derive immense psychological comfort from not deviating from the group. Being the lone dissenter is hard. Munger notes that puzzlement or stress profoundly amplifies this tendency, pushing us even more strongly towards conformity, which can lead to groupthink, blind obedience, and even dangerous mob behavior. The famous Solomon Asch conformity experiments from the 1950s demonstrated this beautifully, where individuals knowingly gave obviously wrong answers to simple perception questions just to align with a group of actors giving the same wrong answer. They couldn't bear to be the odd one out, even when they knew the group was wrong.
Investment bubbles and speculative fads are the absolute poster children for this bias in finance. Think of the dot-com stock bubble again, or the Dutch tulip mania centuries ago, or even the more recent meme stock frenzies. People piled in primarily because everyone else was, despite often clearly irrational valuations staring them in the face.
Precisely. As Munger might put it, investors pile into stock market bubbles, assuming the upward trend will continue indefinitely, largely because others are doing it. Even when valuations made no logical sense based on fundamentals, the pervasive, often unspoken logic was, well, if so many other smart people are buying this, they must know something I don't.
Right, trust the crowd.
Trust the crowd, often blindly. This herd behavior drove prices to absurd, unsustainable heights. The housing bubble had similar powerful social proof elements. Everyone was making money flipping houses. Meme stocks like GameStop were fueled by online forums where collective enthusiasm and shared buying activity became a powerful form of social proof that the investment was sound, regardless of the company's actual prospects. Social proof is also skillfully used in marketing, most popular dish on a menu, customer testimonials, and it clearly drives fashion trends and cultural fads.
And it has a dark side too, right? Contributing to moral lapses.
Absolutely. On the negative side, it contributes significantly to moral lapses in organizations, as potentially seen in the Wells Fargo fake account scandal, where the feeling that everyone else was doing it likely lowered individual resistance to unethical behavior. It also underpins bystander apathy, where the inaction of others in an emergency situation is taken as social proof that inaction is the appropriate response, tragically leading to no one helping.
Wow. So it sounds like it can completely short-circuit independent thought, turning otherwise smart, rational individuals into lemmings following the herd, sometimes right off a cliff.
It absolutely can short-circuit individual judgment. It leads to Me Too behavior and corporate strategy, where companies adopt the latest management fads or make acquisitions simply because their competitors are doing it, rather than for sound strategic reasons tailored to their own business. It fuels booms and busts in markets. It causes analysts' forecasts to cluster tightly around a narrow consensus because deviating too far is professionally risky. It can lead to engineers staying silent about critical flaws, as seen in the Challenger disaster, where group pressure and perceived consensus overrode individual engineering concerns. Munger points out that even inaction by others can be social proof that inaction is fine, creating a dangerous spiral of silence where critical information or warnings are never voiced. It can even feed the dynamics of cult behavior.
So how do we maintain our independent thinking? How do we resist that powerful pull when the crowd is surging in one direction, when the FOMO, the fear of missing out, which is tied to social proof, is screaming in our ears?
The antidote is, frankly, courage and the deliberate cultivation of independent thought. Be acutely aware that the phrase "everyone's doing it" is almost never a good reason to do anything important, especially in investing or major life decisions.
It might even be a warning sign.
It very often is. Munger and Buffett are famous for their willingness, even eagerness, to go against the crowd, buying when others are fearful and panic selling, and being cautious or selling when others are greedy and euphoric. Seek objective, independent evidence beyond mere popularity or consensus. Actively ask yourself, would I still think this is a good idea if literally no one else was excited about it? Look for incentive-caused bias in the crowd. What are their motivations for joining the herd? Are they rational? Explicitly give permission for and even reward contrarian views within your team or social circles. Munger, quoting John Maynard Keynes, noted the sad truth that it is better for reputation to fail conventionally than to succeed unconventionally. Fighting social proof often requires immense internal fortitude and a willingness to potentially look foolish in the short term, to be right in the long term. You have to be willing to stand alone sometimes.
Wow. Okay, that was a lot to unpack, just the first 15 of Munger's biases. We've covered a huge amount of ground, from incentives and liking to denial and herd behavior. I truly hope you, listening, can already see how understanding these profound psychological tendencies equips you to spot so many common pitfalls, not just in the market, but really in your own daily life and decisions. This is powerful stuff.
It's truly transformative, I believe. Just the awareness alone is an incredibly powerful defense against irrationality. It's about becoming a better decision maker. By first understanding how our own minds can mislead us, learning to step back, pause, and develop a more objective lens through which to view the world and, critically, ourselves.
Yeah.
It's about metacognition, thinking about your thinking.
Yeah. And I really encourage you to reflect on these tendencies in your own life. Start observing them in the world around you. You'll begin to see them absolutely everywhere once you know what you're looking for in news headlines, in advertising, in political rhetoric, in conversations with friends and colleagues, and especially, perhaps uncomfortably, in your own choices and reactions.
And remember, this is just the beginning of what should be a lifelong journey of critical thinking and self-awareness. Revisit these concepts. Maybe even jot down personal examples you observe in a journal. The more you practice recognizing these patterns in real time, the more adept you become at navigating life's inevitable complexities and making choices that are more aligned with your long-term goals.
So here's a final provocative thought to leave you with. If the greatest minds like Charlie Munger dedicated their lives to understanding human misjudgment as a key to achieving extraordinary success and avoiding catastrophe, what overlooked bias in your daily routine, maybe even right now, might be subtly shaping your most important decisions without you even realizing it? It's worth a deep dive into your own mind.
That's the ultimate key question, isn't it? The true deep dive isn't just into these fascinating biases Munger laid out, but into your own mind, your own patterns. As Munger and many others would argue, the greatest investment you can possibly make in any market or any endeavor is in understanding yourself.
Don't forget, you can find more resources, including book recommendations related to value investing and behavioral finance, in our episode description.
And just a reminder, all the analysis shared today is based on publicly available sources and interpretations of Charlie Munger's work. It's intended for educational purposes only and doesn't constitute investment advice.
Absolutely. Always conduct your own due diligence before making any investment decisions. If you enjoyed this deep dive and want more, please subscribe to Deep Value Investing on Apple Podcasts or Spotify. Thanks for joining us.